In this video, we're going to discuss the fundamentals right now in the crude oil market. And specifically, we're going to address the question, what happens if OPEC decides to extend its voluntary production cuts that it put into effect in the first half of 2024 and decides to extend these cuts into the second half of 2024. They're going to be meeting on June the 2nd to make this decision. And so we're going to address what is likely to happen if they in fact decide to extend these production cuts as is currently expected. So according to an analysis by Rystad, which is a commodity analysis firm, and we happen to agree with this analysis, is that starting in July, the impact of fully extending these cuts will put the global oil market in deficit by about 2 million barrels, which will actually increase to about 2.7, 2.8 million barrels in deficit by August and about 2.6 in September. So overall, we're talking about roughly 2.5 million barrels a day deficit between July and September if the cuts are fully extended. Now, this is a really big deal, and in the next few slides, we're going to explain why that is. Now, this slide shows crude oil inventories in the United States, commercial inventories. The gray area represents the 5-year range in the level of inventories. And this blue line is just a time series that represents the last year or so. Now, the important thing to see here is to look at where we're at right now. And we've had a seasonal build in inventories that have brought us pretty much to the middle of a range, a little below the middle of the range for the last 5 years. And as we're going to see in the next slide, we're about where we were last year in terms of inventory levels. Now, what happened last year? For that, we need to go over here. What we see is that starting in June, we had a seasonal draw in inventory levels, a very big one that brought us down to kind of the bottom of the 5-year range and very near this 400 million barrel mark, which is considered to be sort of an operational limit for the system. Once you get to this 400 barrel range, bad things start happening, and the price of oil will need to rise very, very substantially to keep inventory levels at this sort of minimal operating level. Last year, we had such a big draw in inventories that we got fairly close. We got down to 420, and at some point we even got below the 5-year average. But the more important thing to look at than this 5-year average is kind of this sort of 400 level. And as we see last year, during this seasonal period, which is the driving season, we had a pretty big draw that brought us down here. Now let's take a different look at this and look at a graph that shows the stock of crude oil inventories in terms of days of oil supply. And what I just want you to see in this particular graph is that we're pretty much where we were at last year in terms of days of supply right now. So we're starting out at the present time very close to where we were last year. And remember, last year we were about here, and we drew into this seasonal period where inventories tend to draw, and we got down to pretty low levels. Now, let's see what happened last year in terms of price, because this is where things get interesting. Last year, in June, this is where oil prices were. And when we had that draw, when we started getting that draw in inventories during the driving season, basically from June until about September, late September, we had a big rise in oil prices that went from below $70 to about $96. So a very, very big rise here during this seasonal period where inventories generally draw. And in this case, last year we kind of drew down to very low levels, to critically low levels, and we had this very sharp increase in oil prices at the time. Now, let's go back and review where we're at, because as we just mentioned, Rystad is estimating that we might actually be drawing 2.5 million barrels down our inventories per day during these 3 months. Now, there's other estimates, and I've seen estimates as low as like a million, 1.2. Let's just call it a million, is kind of the lower end of the range of what various analysts are estimating might be the level of draw per day in terms of millions of barrels of oil per day. 1 million barrel of oil per day would be kind of the lower end of current estimates. Now, what would happen here? Well, obviously, if you look here, what it would take to get us down to 420 from where we're at right now, we're at about almost 460, about 458 right now. What this means is that at a rate of 2.5 million barrels a day of draw, we will be down to absolutely critical levels. Essentially, that level of 400 that I mentioned to you, that is like kind of the critically low level within a month. And it's kind of right around the corner. If in the best case scenario that's currently forecast, we only draw 1 million barrels per day, it would take 60 days for us to get from 460 to that 400 level. So in the former case, which is the case where we have pretty strong demand, we end up getting, we'll get to a really, really big crunch in the oil market within roughly about a month of starting the month of June. So already by sometime in July, we would have very critical level of inventories and shortages that would cause the price of oil to rise. And in the other case, it might take a couple of months to get there, but we'd get there. So I think that this year, we have a very high probability of getting inventories down to very critically low levels and having a big rally the way we did last year during this period of draws and inventories. But check this out. We're starting from a much higher base. Last year we were starting from low 70s. This year we're starting from more like the high 70s. So most likely, if we get the type of a draw that we had last year, we might be headed to a level that's significantly higher than last year's peak, which would put us above $100. Now, here's the other thing to keep in mind though. Last year, we didn't have an inventory draw or an imbalance in the oil market that was nearly as severe as the one that we're talking about here in either of those two scenarios, where we're drawing 2.5 million barrels per day or even 1 million barrel a day. This is a much more severe draw. So under that scenario of a much more severe draw, we probably are going to end up well over $100. Now, it's important to emphasize that in both of these scenarios that I've been discussing, where we just draw 2.5 million barrels a day or we draw 1 million barrels a day, this doesn't assume any sort of disruptions in global oil markets as a result of, for example, Iranian supplies being disrupted, the Houthis managing to disrupt oil supplies coming out of the Persian Gulf or Red Sea or the Suez Canal. It's not taking into account any actions that Russia might take to disrupt or limit the flow of oil. So this is just a scenario of what is going to happen based on oil market fundamentals, even if there's no geopolitical risk that gets priced into the market, or even if there's no disruptions. Because remember, if we start getting geopolitical risk priced in, the price of oil can rise by 10 or $20, just pricing in the possibility of various types of instability that could lead to disruptions in the supply of oil. Now, if we actually get a disruption in the supply of oil, then that's where prices can really spike. How much would they spike? I mean, it depends on how severe the disruption is. A very, very, very rough estimate, and I say rough, is that for every million barrels of oil supply disrupted in the global oil market can cause somewhere in the neighborhood of a 10% rise in the price of oil. So if we're looking at a baseline price of somewhere around $100 in this scenario of an extremely tight oil market, every additional million barrels of oil that get disrupted cause another 10%, or in this case $10 rise in the price of oil. So for example, if we get a 5 million barrel a day disruption in global oil markets, that would roughly get us to $150 in terms of price. Now, there's some possibilities that can mitigate this on either end. First of all, if we end up getting a big disruption like this, we probably get a risk premium priced in as well. So prices probably wouldn't just go up to 150, they'd probably go up to 170 or even higher, depending on what sort of risks the market is pricing in. The other factor to consider on the downside is that we have the Strategic Petroleum Reserve, which the Biden administration can put into play to try to put additional supplies onto the market. Right now, the U.S. Strategic Petroleum Reserve is capable of releasing roughly 2 million barrels a day of oil into the market. And some other U.S. allies could also release additional supplies. So that's another factor that needs to be considered, because under those sort of circumstances, if there's some sort of disruption in global oil supplies, the Strategic Petroleum Reserve would be able to handle that, but only for about 90 days, because the Strategic Petroleum Reserve, based on the levels that we have right now, can only be drawn down by a rate of 2 million barrels a day for 90 days. So there's a lot of different scenarios that would have to be analyzed in terms of how high the price of oil could go in the case of a global oil price disruption. But in this presentation, I really don't want to focus on those different scenarios. All I want to focus on is where are oil prices likely to be before any sort of disruption happens. And based on this analysis that I've just provided you, it is likely that we're going to be getting roughly $100 oil, could be $5 to $10 less, could be a little more, just based on oil market fundamentals, where we have a big seasonal drawdown in inventories that take us to this 420 level, or the 400 level, which is the critically low level. And with oil supplies, inventories down to that critically low level, we estimate that we're likely to get oil prices at $100 before any sort of disruption. If we get any disruption in the face of such critically low inventories, the sky's the limit on how high the price could go. Okay, thank you very much for tuning in, and we will have a video pretty soon where we're going to review some of the scenarios that could actually cause a disruption in the supply of oil. Thank you.